Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KOWLOON Development Company Limited Annual Report. KOWLOON Development Company Limited offers a diverse range of businesses and services. At the core of its operations are property investments, development, and management in Hong Kong and mainland China. The company's portfolio includes various types of properties such as office premises, retail shops, shopping malls, and car parking bays. In addition to property-related activities, KOWLOON Development Company Limited provides a range of services including security, technical, and housekeeping services. It also offers building surveying and guarding services, financial investments and services, and project management services. Furthermore, the company undertakes construction contracts, indicating its involvement in various stages of property development. The company's services extend beyond property development to include treasury operations, retail activities, and film distribution. This diversification allows KOWLOON Development Company Limited to generate revenue from multiple sources and maintain a strong presence in the market. The KOWLOON Development Company Limited market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $17 billion. KOWLOON Development Company Limited trades at a higher price-to-earnings ratio of 47 times and a higher price-to-book ratio of 0.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.13%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company's financial performance can be identified through various indicators. On the positive side, sales of property projects in Hong Kong and pre-sales/sales of development projects in mainland China have contributed significantly to revenue growth. The joint venture with Chinese letter 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 has also seen a substantial increase in revenue, rising by 746% from $90,063 to $760,678. On the other hand, revenue decline can be attributed to factors such as a decrease in gross rental income from property investment portfolios in Hong Kong and a decline in sales of properties. Additionally, property management service income has also seen a decline. In mainland China, revenue decreased by $467,920. The mixed or no change category includes instances where revenue increased initially but then decreased subsequently. For example, revenue increased from HK$1,050 million to HK$4,582 million in 2021-2022, only to decrease from HK$5,390 million to HK$4,953 million in 2024-2025. Other factors such as local property market conditions, overall economic environment, and interest rate fluctuations have also been mentioned as affecting revenue growth or decline. The company is indeed generating positive operating cash flow. This can be seen from the various financial metrics presented on different pages of the report. On page 75, it is stated that the net cash generated from operating activities for the year 2025 was a significant $22 million. This indicates that the company's core operations are producing substantial amounts of cash. Furthermore, on page 129 and page 141, we see additional confirmation of positive operating cash flow. The operating cash flow for 2025 is reported to be $83,985, page 129, and $2,274,297, page 141, both of which are positive numbers. These figures demonstrate that the company's operations are generating sufficient cash to meet its financial obligations. Overall, these metrics collectively suggest that the company is successfully producing positive operating cash flow, a key indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. A review of the financial statements reveals a substantial decrease in debt levels across various categories. Current liabilities dropped from $14,629 to $4,529, while total bank borrowings decreased by $598 million. The gearing ratio also saw a notable decline from 104.4% to 98.8%. Furthermore, loans and advances, trade and other payables, and bank loans all experienced significant reductions. In terms of interest expenses, the data suggests a decrease in these costs as well. Interest expenses have dropped by 30.7% and 32.2%, respectively, according to two different sources. This reduction is likely due to the company's efforts to manage its debt levels and optimize its financial position. Overall, the data indicates that the company has made progress in reducing its debt burden and associated interest expenses. The performance of various segments and regions can be analyzed based on the extracted summaries. In terms of profitability, Hong Kong stood out as a top performer with $567,073 in reportable segment profit. This was closely followed by others, which also reported a significant profit of $43,073. On the other hand, China struggled to make a profit, reporting a loss of -$13,609 in reportable segment loss. Despite this setback, it is worth noting that these regions and segments are not necessarily representative of the entire company's performance. Management is optimistic about the company's outlook and strategy. They aim to enhance their competitive position by broadening business activities in property development, investment, and management in Hong Kong and mainland China. A key focus area is increasing their land bank with approximately 2.8 million sq.m. of attributable gross floor area. The company anticipates strong growth in property development and investment, driven by sales from Upper Manor and rental income in Hong Kong. This is expected to account for the majority of the group's results and revenue in 2026. Management believes that this will lay a solid foundation for future earnings growth. In terms of financial performance, management expects to pay 2 dividends per year, subject to the company's financial performance. They also plan to actively seek suitable investment opportunities in the Hong Kong residential market. Overall, management is committed to driving growth and increasing shareholder value through their strategic initiatives. The company has made several strategic acquisitions to expand its portfolio. These include the purchase of Manor Hill, Upper Manor, Le Cove City in Wuxi, Polytech Luxury Mansion in Shanxi, and a joint venture for Nos. 24, 26, 28, and 30 Fuk Chak Street in Hong Kong. On the other hand, the company has also divested certain non-core assets to streamline its operations. This includes the sale of offices, shops, and car parking spaces in mainland China, as well as film distribution and related rights. These moves are likely aimed at optimizing the company's resources and focus on core business areas. The company has a history of rewarding its shareholders through both dividends and share buybacks. In terms of dividends, the company has consistently paid out to its investors since 2021, with payments made in 2022, 2023, 2024, and 2025. The amounts distributed have been clearly documented on various pages of the report. In addition to dividend payments, the company has also engaged in share buybacks. Although not explicitly stated as a separate section, mentions of share repurchases can be found throughout the document. For instance, page 54 outlines a general mandate to repurchase shares up to 10% of the total outstanding shares. Furthermore, on page 55, it is noted that some shares were bought back in relation to the 2023 final dividend payment. The company's strategy also implies an intention to engage in share buybacks, as mentioned on page 127. This suggests a proactive approach to managing its capital and rewarding shareholders through both dividends and share repurchases. Concerns have been raised regarding inventory buildup and its potential impact on businesses. A significant increase in the write-down of inventories was observed in 2025, as stated on page 128. This indicates that companies may be struggling to manage their stock levels effectively, leading to a potential issue with inventory buildup. That concludes the financial summary for Kowloon Development Company Limited. Feel free to comment below, and I will be happy to answer them when possible.